Here I'm going to use the activity method of depreciation. We have a truck that was purchased on January 1 for $85,000, so you would debit the equipment account and probably credit cash or payable. As far as the company's expectations, they estimate that the truck will be used for 5 years and over 100,000 miles. We're going to use activity method, so the number of years is not relevant. The estimated salvage, also called residual value, is relevant because here's how you do activity method. You take your depreciable cost in the numerator, just like with straight line, and that is your 85,000 minus your salvage value. So they have $70,000 of usefulness. Then what they're going to do is divide it by the total number of miles. Activity miles makes sense to use for for trucks. If it was an oil company, you'd probably use barrels of oil. Whatever makes sense for the asset that you're depleting or depreciating or depleting. In this case, so when we do this, we get a rate per mile, which is your 70,000 divided by your 100,000, or 70 cents per mile. So the amount of your expense is going to depend on how many miles you drive. So activity method reflects the actual activity much better than any other method. So then, in other words, if you drive it a lot, you have more depreciation than if you drove it less. So the way you calculate the amount of the expense is you take your rate times the miles driven, and there were 17,000 miles that was driven in year 1. So the entry for year 1 as you debit depreciation expense and credit accumulated depreciation. So here we have 11,900, and likewise for your depreciation expense. As far as at the end of year 1, let me do the sum. As far as year 1 goes, on the financials, you'll see depreciation expense of 11,900, and the equipment net on the balance sheet will be this minus this, the amount of usefulness left, plus the salvage value. Now, when we get to year 2, let's change this. What we will record is, do away with this entry for now, is you're going to use the same rate that you calculated. It's going to stay the same, and multiply it by, in this case, there were more miles driven, so the expense is going to be higher in year 2. So I'm going to record that. Now, the beginning balance for accumulated depreciation is 11,900, as is the equipment. The depreciation expense got closed last accounting period, so its beginning balance is 0. Now, as far as when you record your depreciation as an adjusting entry at the end of the next year, year 2, you would be recording the following. What's going to show up on your financial statements is on your income statement for the year ended December 31, year 2, it'll be 20,300. Not the sum of those two, even though it's in its second year. This got closed into retained earnings last year. But the accumulated depreciation has accumulated, and the net of those two is the book value that goes on your balance sheet. Now, for extractive industries, they tend to use activity method because they keep track of their activity. It's already in the computer system. But if you think of UPS trying to do this with its trucks, it would have to go to the odometer for each truck. And if you think about it, in year 2, they'd have to subtract what the miles were in year 1. It's not feasible. That's why most companies use straight line. In fact, if they required companies to use activity method, UPS would be it would be an undue burden. By the way, did you know FedEx and UPS merged? Yeah, they're called Fed Up. And that's what you'd be if you try to use activity method using miles on trucks.